O7Capital Group podcast with another episode. And today we have our COO, Mr. Jason Cronin. How you doing?
I'm doing well.
Beautiful. For people who don't know you, we're going to introduce you in a second, but it's great to have you here. We have a very interesting topic, but for the audience that asks me, sometimes, clients ask me if we are doing just commercial real estate or we are doing M&A, we're doing both. So it's pretty surprising to people that we are doing both. But today we're going to speak about the commercial real estate angle just because we see a lot of traction lately. We're working on a few deals together. So we would rather to focus on that, but at the same time, we are going to have a session. So it was very important for me to mention because lately, Jason, we've been getting some emails from people from the M&A side. Hey guys, it seems like you only do real estate lately. No, we are still doing M&A. And next week, actually, Jason is going to meet a few entities that are related to the M&A space. Jason, how you doing in general? You are in the Maryland area. Anything special is going on right now over there in your area?
No, yep, I'm over here in Maryland, East Coast. Nothing too special, hitting the springtime, so that's always good. Get out of the snow and the cold, and starting to really pick up here at O7.
Exactly. We're gonna hear more about your story in a second, but before we start legally, we have to do this. I have a quick disclaimer. Before we start, quick disclaimer, this interview is for informational and education purposes only. It's not an offer to buy or sell any investment or security. This is not an investment advice. For more details, please check our website or the description below this video. We got that out of the way. I have a question for
Sure.
you. We've been working for a while now, Jason. You and our company, we're exchanging services between your entity, our entity. You joined the team. We combined forces. You came from a different environment, had other opportunities on the table when we initially spoke last year. Let's start there. What was about kind of this opportunity, O7 Capital, what we work on that made you say, this is what I want to do, this is where I want to build, because it's a long-term play, as you
Yep,
already know.
yep, absolutely. I'd have to say, I guess there's two main reasons that I came. So the company's focus on keeping the process simple and streamlined. That's the way I've always liked to work. I don't want to make things more difficult for clients than it has to be. And then the second one is the team that O7 is building. I found it a great place that we're going to be able to collaborate, take everyone's experience and network, and really add value to our clients.
Yeah, most definitely. And remember when we first met, we kind of had that initial process. We went a little bit back and forth. I was reviewing your background. I was really interested if this is something that you want to shift to, because again, there is a licensing process that was involved, a legal process. Nobody wants to do that, let's be honest. Like again, it's passing a few exams, working under a broker dealer on your end. So kind of you shifted to that. That's one. And two, I tried to, when I told you about our process, I tried to keep it pretty simple. And sometimes it's even not too good to be true, but hard to believe because when we are not comparing ourselves to an investment bank because we're not, we're not comparing ourselves to a broker dealer because we are not, but at the same time we are in the space of capital alignment, connection management, right? So it's more about relationships. So you were asking me a little bit about, is that what we do? Like we manage connections on a regular basis. Are you going to just intro me to specific individuals and then let them do what they do best, right? We always see that. And even right now, when you meet some of our clients, some of our connections, you use that phrase, right? That we kind of implement it all the time. Like we let you guys do what you do best. Do you see that when you speak with clients? Is that different than other kind of opportunities that you thought about?
Yeah, actually, no. And that was another, I guess, number three reason for O7 was just the fact that it was more about, nurturing our network, relationship building, bringing people together. That's really what I've enjoyed doing, over the past few years in my previous career. So I wanted to, yeah, let's expand on that. And again, keep it simple and let's streamline it.
Beautiful. From your seat, you personally work on the execution side, deals under a broker dealer, licensed. You working on deals, having conversations with both sides. What is the biggest misconceptions? And we're going to dive into value right now. Sponsors have about LPs, right? You work with independent sponsors, you work with up and coming sponsors, and you work with experienced sponsors as well. When you're working with those institutional LPs, mid-size LPs, no high net worth individuals on your end, where do you see the misconceptions? And then I'm going to ask you the flip side of that. Where do you see the opposite when you speak with
Yep.
LPs? Do you see even misconceptions?
Yep. So I would say, I guess if we're looking at the what sponsors kind of get, the misconceptions about LPs, I would say the main one is that LPs are not a monolith. A family office RIA, community bank, institutional funds, they all have completely different mandates, timelines, different risk exposures. Um, they don't necessarily lead with IRR, especially family offices. They're going to prioritize capital preservation, trust with the sponsor, and long-term compounding of returns rather than just a deck.
Right. Get us inside of the average mid-size institutional LP, kind of get us inside of that mandate because sponsors, obviously mid-size sponsors that already worked with them in the past, they know the process. But let's say I'm an up-and-coming sponsor right now. I've done deals with high net worth individuals, let's say, right? I got those 10 checks, 15 checks per deal, or 3 or 4 anchor checks. Now I'm shifting into the LP world. What should I do? How should I prepare? Is it all about preparation? It's all about returns? Like how the process works on the LP side.
Yep. So like I said, LPs are looking to build a relationship with a sponsor. So even though we have to look at each deal individually, when the LPs and the sponsors get together, it's going to be extremely important for the sponsor to come with a pipeline of deals. We're not looking for a one and done on the relationship. Like I said, LPs, they want to build that trust. And, as I think we've always said, LPs want to do 45 deals with 15 sponsors, rather than 45 deals with 45 sponsors.
Exactly.
So the sponsor that comes prepared, they're going to get priority. Sponsors that have history, the sponsors that survive downturns. Sponsors, again, that can bring the pipeline.
What makes it a straight no-go for an LP when they look at a deal? Like straight red flag.
Um, Straight red flag, if we're taking out possible geography limitations, I would say sponsors that are on their very first deal. That's going to be the hardest one to find. Not saying they're not out there and, LPs won't give them a shot, but if the sponsor doesn't have, I guess we could say a pedigree background as well, it's going to be a lot more difficult.
Right.
If it's their first deal, if they just left, a big firm and they're going out on their own and they have that background, that's something that LPs will work with.
Right. And it's very important to mention, we are speaking about institutional LPs, right? And kind of describing the profile on my end is they're usually looking for, as Jason mentioned, for long-term partners. So they're looking to do multiple deals a year and they have institutional capital. Institutional capital is way different than the average high net worth individual or even the average family, small family offices, family and friends, or again, small RIA that is private and has the ability to deploy capital whenever, right? And wherever. With the institutional partner, what we see is they have big disadvantages. And as Jason mentioned, if you do not hit their investment box, their specific mandate, it's going to be a quick no-go. Jason, just before this session, he shared with me, like, he presented a few deals. He's talking with LPs on a regular basis, etc. So he's just said, hey, check this out, check out this feedback. And we just got, detailed feedback with why it's not going to be a good fit. And sometimes for you, right, Jason, as somebody that's connecting LPs and GPs, that doesn't really make sense. But at the same time, you understand they have multiple buckets, multiple funds. Every fund has specific criteria. So it's a little bit harder to understand how they think, but that's the disadvantage. But the advantage is if you take that as constructive feedback, you work on that, you do reverse engineering based on that, and you
Right.
create that investment box, you hit that investment box, it's an open checkbook, correct, Jason? Like we saw that. Um, so that's great. Now, we're going to come back to it in a second, but let's talk about this year, 2026. We're ending Q1 right now. We had a very interesting Q4 2025. Now we are at 2026 Q1. You think that this could be a potential like breakthrough year in terms of the market, interest rates, deployment? We had dry powder for a few years. It was pretty hard for the entire market.
Yeah.
In terms of deals execution, how do you see this year that makes you bullish?
Yeah, I'm actually really excited for this year. I think already here in Q1, we've seen the turnaround. We have a lot more deals coming across our desk every day. I think they say real estate pretty much bottomed out for most segments in the end of 2024.
Right.
So we're starting to see that rebound. We have rates that are, even though they did not lower them the other day, they are on the downward trend. So as long as we have that going, I think we're good. And again, the LPs, they have the appetite to return. It's just, their mindset has kind of shifted a little bit.
You speak with a lot of LPs, not just about specific deals. You speak with a lot of LPs, as we speak with a lot of LPs on a regular basis, not presenting them deals, just getting some knowledge from them. They show us stats. Do you see that they are one more eager to get inside of the market? Because a few years ago they were super selective. Now we're not deploying. We're just doing that. We're just doing pref or whatever. So do you see them being more active? And like, what are the kind of conversations do you see? You just sent me a report before this session showing like the deployment rate, I don't know, went 6%, 10%, 20% up. So do we actually see that in the market, or just those just numbers that maybe we'll see in the higher end market?
No, we're seeing that. Again, a lot of the increase is due to, increased values on the actual transactions themselves.
Mm.
But we are seeing the LPs deploy capital. You had mentioned earlier that we had that response from one. They just said that they're almost tapped out on their fund. They just closed 2 deals in the last month, and I think they were closing 4 or 5 since Q4 of last year.
That's
So
incredible.
they are deploying.
No, that's incredible. And that's a great sign. That's the best sign. You know how I see that if we speak about commercial real estate? If I see more and more deployment in opportunistic conversion and ground development, that means the market is shifting, because the market was stuck on those existing properties, B plus, A minus, or core plus like opportunities, just because less risk, right? Longer term, so you can hold. Obviously, money is very expensive, was very expensive. Now it's still expensive, but not that expensive. So you can really aim for long term. Back in the day, we just saw demand for 2000s in terms of year built, 2005, 2010, 2015. You see what I'm saying? So it was just like newer and newer and newer. And now we see more and more firms, right? You can mention a little bit about the Ohio firm that we spoke with recently. They said they were doing 70s and 80s projects, right? In
Yep.
Georgia and markets like Georgia, Carolinas, Florida.
Yep.
So we actually see that, right? We see, and they're raising capital. We asked them. They just told us they raised the entire capital from their own network. So we
Correct.
see deals, and that's the most important thing I think for the market, right?
Absolutely. Yeah, we just talked with another sponsor yesterday down in this was it Texas or the South area?
Yep, yep.
And he's looking at over 100 deals, a year this year.
Mm-hmm.
Yeah, probably close on 5 or 6.
Right. They were aiming to do 600 to 700 units a year.
Yep.
He said that they were pretty slower, and they were opportunistic regarding the opportunities, right? They can do class C, class B, class A. So they are a little bit more diverse versus the ones that only doing value add or only doing, core opportunities. So it's a little bit easier for them. But at the same time, we asked him, okay, your goal is to do 700 and we're closing Q1. How much do you have? He said like 25% is done already. That's super impressive in this market. And again, I'm always comparing that to 2022, 2023. I want to see the trend, right? We want to see the trend.
Yeah. And the fact they're investing in the established units already, and that's not something LPs are turning away from. If the cash flow is there,
Exactly.
they're ready for that as well. So it's not all just about, class A new development.
The main kickback, from my understanding, was, and it still is, not for the entire market when it comes to LPs. The main kickback, again, I'm getting this knowledge from sponsors, was the year built. So it's not about the cash opportunities or the projections, the targets, and everything. Sometimes they get great deals on paper, but just as you mentioned, based on a mandate, based on funds the LPs raise already, or like a specific mandate, they cannot do older than the 90s or older than 2000s, and then it's a quick no. Now there is an opportunity in the market, in my opinion, for those, because if the institutional players are not playing in this field, you have more opportunities for yourself, right? Less competition,
Yeah.
and then you can get those deals. So I feel like there is a huge opportunity until they come back. If money will be a little bit cheaper, they will come back to those heavy value add redevelopment deals, and we're going to see that. And actually, we already see that. Like, you want to mention a little bit about the family office, the super creative family office that we met. They were doing just opportunistic deals, right? And they were looking for value add opportunities. They can do everything. So it was pretty surprising. Not surprising, but it was like, okay, we are a family office and we only do heavy value add opportunistic deal, high returns. We don't see that a lot with players right now.
Not a lot, but they're there. Again, it goes back to that misconception that, all LPs are a monolith. They're
Right.
all different. And that's one of the benefits of, working with O7 here is we get to see that. So when, the sponsor comes to us, we learn about the sponsor and we know, what LPs are, we don't even approach them. It's not a let's spam it out there.
Exactly.
'Cause we know that it's an instant no, just based on their criteria.
Exactly. And we don't offer deals, by the way. We don't offer deals, LPs. Our goal is to build legit relationships with them.
Yep.
When we approach them, we don't say, hey, we have a deal. We
Yep.
don't say that. We say, hey, usually it's like an intro, like through our network, and we meet the people, we understand their criteria, we understand what they want. We build a legit relationship with them, not based on sending them deals and offering them securities that we are not. We are building a relationship with them. And as soon as some of our clients, right, the sponsors have a deal, we get people like Jason to execute on the security side, on the offering side, and we go from there. So that's super interesting. Now, speaking about LP appetite, obviously, right, you spoke with tons of LPs. Every LP is a little bit different, but let's talk about, asset type. What do you see? Like, what is popping right now? You mentioned existing is always going to be good, but in terms
Mm.
of asset type, what do you see that is working more on your end, and what is like a no-go?
Yeah, I would say right now, multifamily is one of the hottest plays that we see right now,
Mm-hmm.
both existing and development. We've seen a lot of industrial. Again, maybe staying away from single tenant industrial, doing a lot of like smaller bay,
Mm-hmm.
avoiding those big box markets. Retail has kind of a 50-50, depending, some of the like smaller neighborhood retail stores that have that strong anchor.
Right.
They're kind of overlooked, but provide a good opportunity. And then, lastly, I would say conversions. Conversions have really been popular, doing a hotel to multifamily conversion or even taking an old office
Right.
to multifamily conversion.
And that's I wouldn't say that's surprising. We already saw that with COVID when, vacancy was pretty high when it comes to offices. What's surprising to me, it's not New York and California anymore when it comes to office conversions and hotel conversions.
True. Yep.
We see that with offices in Oklahoma, in Dallas, in Georgia, so we see that as well. Obviously, people are working, they are coming back to the office based on stats, but at the same time, I feel like some of the specific areas, we just see the demand for residential, and that's why we're going to see those conversions, and maybe offices will be a little bit away from that specific area, or we're going to see more like small offices, more hybrid. We're gonna see that, but again, we are not really into the office space or the hotel. So I'll kind of complete my question. I think that red flags for us, again, just for us, some people like those asset types, but anything that relates with hospitality is not really a goal from us, right? To look at office. I think that we do have prospects that are interested in office, but it just seems like so hard to do, so hard to get the right deal for it. And our sponsors are really, really eager to get deals done in the fields that Jason mentioned. So we are not really seeing a lot of offices, although I do know a few that are doing pretty good when it comes to offices. So that's very interesting. Um, Conversions, it's been one of our, as Jason mentioned, it's been one of our top fields that we see. We get a lot of deals from sponsors to review, right? Help them with structuring, due diligence, everything like that. So it's super interesting market. Now, do you see more appetite? I already mentioned that, but do you see more appetite for shorter holds, longer holds? What do you see over there? Like, what is the average?
It's a mixed bag, but I would say the majority are still, underwriting that 3 to 5 year period. Again, a lot of the LPs are looking for, maybe even 5 to 7. Very few are doing the 7 to 10, but I would say anywhere from 3 to 7 is the sweet spot.
Yeah, makes sense. Some of them are still going to have that bucket, right? Of long-term 7 to 10 years. But again, the market didn't change when it comes to, when they are willing to get back the returns, right? 3 to 5 years, it's just going to be classic with private equity. It is what it is. Like, maybe with development, you are aiming for 5 years. And that's why, in my opinion, Jason, the conversions are so interesting. You remember when we first spoke about conversions and you asked me, hey Matt, what is the length for this project? And I said, 12
Hmm.
months, 12 months, 12 to 18 months to convert it. So it's not like a classical development deal that takes you at least 3 to 4 years to build,
Yep.
right? So conversions, the big advantage with it is like usually 12 to 18 months. It really depends, right? If you have on a hotel, it's a little bit easier just because of the system over there, and you can combine rooms and everything just a little bit easier. But 12 to 18 months, usually you already have the parking lot in place, so it's easier for you. And it's a light, light development deal and not like grown up when you have all of those kind of permits and contractors. It's just a little bit right easier for conversions. What did you like specifically about conversions um, besides the quick turnaround?
That's the number one, the quick
Right.
turnaround. It's what the capital wants. They want that quick turnaround. It's
Location as well, right?
yeah. I mean, you get great locations, less red tape with government getting the entitlements. You're dealing with the building permits and all, but you're not starting from the ground up with entitlements.
Right, right. Speaking about sponsors again, what's interesting about this market, we meet a lot of sponsors. Some of them are truly struggling, seems like. Some of them are out of business. Sponsors that we spoke with a few years ago now out of business just because of the market. Some of them are just doing great, head of the market, right?
Yep.
Is it because traditional kind of lending have been that's the field that is being pretty tight? Is it about LPs are being very selective? What was the reason of them doing great during 5 years ago, and now some of them are truly struggling versus the market that is getting the
Mhm.
deals, just getting deal flow?
Yeah. Well, I think a lot of them were probably over leveraged, didn't see the
Mm,
downturn coming. I don't think most people saw the downturn. But that's where you have the difference of the sponsor. Do they have that experience going through down markets? And the ones that had that experience or had the advisory board to help them knew how to prepare.
you either exited at the right time or you had specific asset types that weren't that affected. This is how I see that. Because
Yeah.
if you were over leveraging development deals of specific asset types in specific areas, you got hit really, really bad. And then defaults, right now, we even see in the market, you can go on LoopNet, you see distress offers, you see developers that are pre-selling their development deal. It's not completed yet, so we see more and more of that. And I actually speak with one of our colleagues. They are focusing on foreclosure default, looking at tons of deals right now. Not all of them are good, obviously, and they're bidding on all of them. And I think that even large institutions have a specific bucket to buy those at an overpriced, but buy those just to have them in place for the next 3, 5, 7 years because they can hold for 20 years. But at the same time, you are going to see a lot of opportunities. Retail as well. You see a lot of opportunities with retail. They're a little bit smaller, more vacant. Back in the day, I had the chance to meet a group that were doing, they were buying like 30 to 50 up in shopping centers that are vacant, making quick value add like in 6 months, 7 months, 8 months, and then selling that back to the market, back to as a value add opportunity. So we saw that. Here, I just speak with them and they say volume went down significantly just because money is a little bit more expensive. We saw less demand for it. So it's fascinating. Now, coming to the LP side, Jason, if I'm a sponsor right now, in terms of check size, right? You, Jason, you work on deals that are like, what is the total deal size and what is the check size that you usually work on? What is the appetite in the lower middle market? I'm not speaking about handful individuals, but at the same time, I'm
Yeah.
not speaking about, the large institutions that are doing $50 million, equity check size per deal.
Yeah. Most of the LPs that we're dealing with, they're looking to deploy anywhere from 6 to, 35 million. Six even kind of being on the low end. I'd say 10 to 25 is kind of the sweet spot for most LPs. Again, kind of if they're looking at the typical like 90-10 split. We do have a few smaller family offices that can do some, sub 5 million. But again, it seems like the trend is going a little bit higher.
Right, right. More demand for like 10 plus, right? 10 to 25.
Absolutely. Yeah.
And that makes sense, when the market is getting a little bit more healthy, like healthier, and when I say healthier, it's just interest rates are going down as we see more deployment. Obviously, LPs are going to come back to their roots and investing specific buckets in out of specific buckets the bigger the better, right? For LPs. If I already have money to deploy, obviously I'm just going to look for, as Jason mentioned previously, less sponsor and more money to deploy per deal. It has a cap. I'm not going to compete on $50 million opportunities. But at the same time, if I'm considering 6 to 35 million, obviously 10 to 25, 10 to 30 will be my sweet spot. So we see that more and more. But I think that from your end, you still see some of them that would entertain 5, 6, $7 million, right? Per
Hmm.
deal for the right location, for the right
Yeah,
sponsor.
absolutely. For the right location and the right deal, they will look at it.
Now, as a sponsor, when you present a deal to an LP, is it all about the flashy deck, flashy experience, all about the returns? What do you like from your perspective?
Yep. So it's again, I think we hit on it before. It's more about their background, their history, how they did over the past 5 years with their previous projects. And again, that pipeline, are we starting a relationship rather than just a deal?
Right, right. And when we speak with sponsors and they ask us, what makes the LP tick, right? What will get them intrigued? Because LPs are getting, I don't know, bombarded with deals. I think that 20 deals a day, right? 50 deals a
Oh,
day,
easily. Yeah.
everything.
Yep.
Especially if those are like flexible LPs that are doing multiple asset types and they have multiple funds. So obviously, as a
Mhm.
team, not a specific individual is reviewing 50 deals, but they have teams of hundreds of people, sometimes 50 people, 20 people, even the smallest teams, like 10 people, right? It's enough to review multiple deals at the same time. We have AI that is really helping people like us, people like them. So but yes, you always start with a deal. You need to have a good deal to start to kick off a relationship. But at the
Mhm.
same time, a lot of LPs say, we want to meet the sponsor. Even you don't have a deal, but based on their track record, we want to meet the sponsor. So highlighting what you said, Jason, when you have the right track record, when you have the right experience, that's where you can vet the right deals. So this is why they like you, right? It's not just about your experience. Oh, I was working at this company or that company. Yes, it helps, but it's like, okay, based on your experience, you already went over a lot of these in your career, so you know how to identify the right ones for us. So,
Yep.
and if they had institutional experience, either working at an institution, so coming from their point of view,
Mhm.
or already doing some deals with institutions in the past, working at a specific company, that is really helpful because they know how to speak their language. The language is like less information, more about the story of the deal and why it fits our investment bucket, right? So it's reverse engineering. I give you my investment bucket, you tell me why it fits. While in my opinion, Jason, what we see in the market with just smaller sponsors that are working with high net worth individuals, we see it's all about me, right? Because LPs that are like again, smaller LPs are less sophisticated, right? They don't have a fund that they raise for or whatever. So for them, it's more about you lead the way. You've done 100 deals in the past. Those are the historical returns. We want to dive into that. So I want to see the flashy decks. I want to see the flashy presentation, the flashy webinar. While with institutional Ps, it's more about okay, show me your ability to source one good deal and then source three more of those.
Yeah.
Can you be consistent? And that's, in my opinion, the real thing with those institutional Ps. Can you
Yep.
be consistent?
Yep. And I'd add one more thing too.
Yeah,
I would say, when you provide them the information, make sure you're giving realistic underwriting. Let's not underwrite it so the project looks awesome, and then the LP sees it and they go through their underwriting and everything's cut down by 20, 25, 30%.
exactly.
Again, that's going to take away from the sponsor's credibility.
Being conservative when it comes to underwriting, I think was one of the biggest, like the most important keys for that, right? Because here is the thing about projections and everything. You can inflate them easily, right?
Yeah.
Easily. Some large institutions say you cannot eat IRR. You see what I'm saying? It just sometimes it's not feasible, right? You can start with that, but even right, Jason, when you present a deal, you're not even presenting IRRs. You're not even presenting the projections
No,
because
no.
the LP is going to underwriting anyways. It's
Yep.
just like a benchmark for you. Okay, yeah, if you are doing a core strategy and you're focusing on lower IRR, it makes sense. It makes sense.
Yep.
And sometimes it's too low for them to even look. It's good for the initial underwriting process, initial due diligence process. But at the same time, think about it, right? Let's say I'm inflating numbers, and then when they underwrite it pretty conservatively, because they are going to do that, right? They are going to do that because it is what it is. They are looking for minimum risk, and even if it's a development deal, they're still going to look at the worst case scenario, right? Where they are not getting the 90% occupancy within year one, year two. So they're going to take a look at that. They're going to take a look at third-party management if it's going to be much more expensive. So more expenses on their end. So they're going to look at this. And then the IRR goes from X, right, to 8% less, and you are in big trouble because they are not going to see you as credible sponsor that was taking under consideration all of these scenarios. So that's
Yep.
the alignment, in my opinion, Jason, for
Yep.
them. So it's like, yes, I'm very conservative when it comes to my underwriting, and I know what institutional LPs are looking for. And then when they underwrite, the correction is not going to be that major, right? The gap between how they underwrite is not going to be that major. And if you can really hit their investment box, and sometimes they are going to be less conservative than you, that's where I see a really good fit, right? How do you feel
Yep.
about that?
Absolutely. I agree 100%.
Lovely. So we're gonna do a um quick Q&A. I'm just going to provide you with an asset type. You're gonna tell me, is it hot or is it not? And we're gonna end our conversation. Multifamily,
Multifamily, hot.
super
Mainly
hot, right?
value add plays, workforce housing where there's solid income in place.
People need to people need to stay like people need to like a place to live in, and I feel like people love the product,
Yeah.
multifamily. People
Yeah.
love
I
it.
mean, it's always in the news. You know, we have a housing crisis. The need is
Exactly.
there. The need is there.
I feel like it's a little bit more affordable than the typical home that you can buy, or even a townhouse that you can rent, or like
Yep.
a house that you can rent. It's a little bit more affordable, and I feel like the younger generation looks for more amenities, right? So you have your gym, you have your sometimes office spaces. It really depends where you live, but you have office spaces, gym, you have your lunch, right? You have a coffee machine, you have your front desk. If it's a gated community, it's a little bit more safe than the average home. People are looking for that as well. I personally love multifamily, especially
Yeah.
if you want to be flexible, right? If you have a small family, you want to be flexible, or you're like a student, you want to be flexible as well, and you want to move every year, every 2 years, just easier. Especially when it comes to furnished properties, just easier because for you, as somebody who wants to move, you're like, okay, I need to rent this house. Usually it's not furnished, right? I need to buy tons of things. So my movement cost is pretty high. So that's why multifamily offices. And it's a little bit more affordable. Again, I'm coming back to this. Usually it's like anywhere from 1,500 to 2,000 in most areas for a
Mm.
single bedroom. It can be a little bit lower if you are, living in specific areas, specific states, but it's still a little bit more affordable than the average house that you can rent, obviously buy right now with property taxes and everything. So that's super interesting. How about industrial? You kind of mentioned the type of industrial, but
Mhm.
post-COVID, it's just booming, right? Industrial is booming. We see a lot of warehouses, but you want to elaborate on that? What do we
Yeah,
see?
we warehouses, we got the small bay, even like storage,
Yeah.
outdoor industrial storage. It's huge right now. Especially like Midwest, Southwest. I mean, it's there and the opportunities are there too.
Just
We're
because
seeing
it's
we're seeing
predictable,
we're seeing quite a few great deals come across our desk.
just because it's predictable, Jason, like you have specific tenants and just they just pay the bills on time and it's predictable, it's long term.
Yep.
I saw a lot of movement. Obviously, all of those multi-tenant industrial properties are great. I saw some traction for self-storage. It was huge during COVID. Predictable. People want to store their stuff and they're
Yep.
paying on time, and it's predictable. You just get the credit card and they pay on time, and it's easier to vacate them as well.
A
Okay, you're
lot
not
easier.
paying,
Yeah.
I'll vacate you. You see what I'm saying?
Yep. And
It
then,
just
a month or two later, it's filled again with the next
exactly.
client. Yep.
Exactly. I was in Dallas, we have so many of those. And I was just asking, yes, we have some, free slots, but I'm like, what is the occupancy rate? As a real estate
Hmm.
person, I always ask, and they say always 85, 90%. I'm like, that's incredible. That's a sweet spot
Yeah.
because you can raise rents if you want a little bit. You can raise, right, the what you charge a little bit. So you have that room and you can always showcase an empty one. So the sweet spot is like 85, 90 percent occupancy rate. So that's great. How about retail? Back in the day, we saw a lot of open shopping centers, closed
Hmm.
malls. I feel like we
Yep.
see less closed malls right now, right? More.
Yep. I think most of them are stabilizing that are still around. Again, we talked a little bit earlier briefly, neighborhood strip centers. especially those with like a grocery store anchor or like a necessity-based tenants. Those are the ones that, LPs are looking for.
For sure. We saw some, I wouldn't say conversion, but we saw rezoning of a lot of those super distressed areas. We saw that as well back in the day. Now I feel like when money is very expensive, we just don't see that a lot, right?
Mhm.
But we saw some rezoning and we saw some redevelopment to warehouses, right? You have that mall and you turn that to a warehouse. We saw
Yeah.
that because the space is pretty big for that, and it's just easier to convert that. But I don't know, lately we are just getting strip malls, right? Open shopping centers. That's what we like to see, multi-tenant. And the last thing, the elephant in the room, what about office? How do we see office? And you know what? I will include hotels as well.
Yeah, that's a mixed bag. I think you might be a little more bullish on it than I am. Again, depends if we're looking at, the downtown urban class A versus the class B and C.
Right.
Uh, but again, let's bring it back to conversions. It's a great opportunity with those assets.
Personally, I just it never penciled down for me, honestly. When I see an office, if it's not a super distress opportunity, foreclosure, whatever, just
Yeah,
doesn't make sense for most of our clients. Again, probably people will, hear what we speak about, like some of our broker colleagues or whatever, and they will say, yeah, we done like 3 offices this year or 4. That's amazing. Usually,
yeah,
if you specialize in offices, you can do that and you have the clientele. But for the average LP that is a little bit more opportunistic and they focus on multiple asset types. I just don't see that. And LPs move the market. I just do not see that unless it's, as Jason mentioned, either a conversion or some sort of like a class A 2018, 19, 20 build that you want to sell below market rate. That's how I feel about it. Beautiful. What I will add is this, just not a prediction, but kind of how we see that 2019, let's say, versus 2026. I feel like there is a huge gap for proprietary off-market deal flow and just intelligence. I feel like the market will appreciate groups like us that are doing more due diligence, and it's all about due diligence and vetting the real relationships versus the entire market that is like, it's been very tough for most brokers, most investment bankers lately, both on all ends, right? Raising capital, um, you know, GP to LP matchmaking, whatever. It was very, very hard just because the market was pretty selective. But there are always going to be deals, always. Like you are going to find the opportunity. The market is not dead, that's for sure. But in my opinion, the gap is getting wider and wider between the average sponsor and the average LP, just because the average LP is looking for, they're just not looking for multiple sponsors to focus on multiple deals. So that means they tighten their reach. They're like, in order for us to get in front of a new sponsor and actually deploy money, not just say we want to deploy money, actually deploy money, you have to have great preparation. And that's, I think, Jason, that's what you and the segment that you focus on really can be helpful, right? Prepare the
yep,
sponsors. So just find a word for the average sponsor or for the average LP, both, that comes to you. What will be the typical process when you meet a sponsor? You want to vet them down a little bit, go over their experience. What would you want to highlight, and what would make that specific sponsor stand out? Is it just about their deal flow, or you want to see something else when they speak specifically with you and they ask you about your process?
yep. Again, it's the deal flow, it's the credibility. I want to hear about your background. I want to hear about not only, the projects that were successful, but the projects that were less than successful.
Hmm.
And how did you mitigate the loss? Those are things that we need to cover as a group. And again, that way we can help align with proper LP. Again, the opportunities are there. It's just about, bringing them together and closing that gap, getting the sponsors and the LPs in alignment with what they're looking for.
Should they approach you only when they have a deal under LOI, or can they strategize with you? Because a lot of those sponsors do not understand that, and they always ask us specifically. Should you have a
Yeah.
deal in place already, or can you strategize?
We love when the deal is fresh under LOI. You have more time. It's not as much of a crunch. Hey, we have 3 weeks, to get this closed. We need some introductions.
Right.
Um, so really, there's two ways of looking at it. Come fresh with a fresh deal, or again, sit down with us. Let's get your information, background, learn who you are as a sponsor, and that's where we can make introductions beforehand. That
Mhm.
way, when you learn what the LP wants and, here's our mandates. If you can find deals that meet those mandates, that's when you're going to get things closed.
That's a
So
huge
it's
advantage.
strategizing for the future.
That's a huge advantage in my opinion, Jason. So just to
Absolutely.
clarify, you say that as a sponsor, I can approach you and say, listen, Jason, historically, this is what we have done. We are looking at deals. We don't have anything that is under LOI yet. What do you feel about our deals? You would be able to make your own quick due diligence, review my background, and then align that with specific LPs and come back with specific criteria based on that. And even before I have deals, potentially meet some LPs, not based on the deal, just based on introduction. I can meet some of your LPs and strategize the next couple of moves just for me to have better chances of getting deals done.
Absolutely. Because during that period, that's where you're building that trust relationship. Because like
And
I said before, you're not going to just sit down and say, oh, here's all of our winners. You're going to say, here's the entire portfolio.
right.
Open, the door to the relationship.
And it's priceless getting direct feedback from LPs before you get deals, in my
Oh,
opinion, for the
absolutely.
average sponsor.
Absolutely. Yeah.
Right?
Like we always say, I mean, once you, mark those or check those boxes on the mandates, it's so much easier because you're working together.
How many sponsors come to you and say, we have access to institutional products, but we're not pursuing on them because we do not know what they really, really want, and we do not have direct access. We don't want to cold emails. We don't want to
Yeah.
do networking events. Like we have
Yep.
access to deals right here, right now.
Yep. And we do. We get that a lot. We get a lot of the sponsors that are transitioning from, doing deals with, high net worth individuals, family and friends. And they finally got to, oh, I have this deal, but I've, maxed out my network.
Right.
So that's when, they've come to us and, again, we can help them sit down, look over it, explain the kind of structure that the LPs are looking for and help them get it ready for presentation
And
when
is
they
it be and is it
introduce.
because Jason, they do not have enough money, or their own LPs don't want to do this deal they maxed out, or is it kind of both, right? Why they look at a deal? When I look at a deal, right, I'm like, hey, money is not an issue if it's a great deal, right? If I need to
Yep.
raise a little bit more money, so why they are going away from this? Is it just because they don't have the money, or they're looking for a programmatic partner? What is the main
Yeah,
reason?
I'd say they're looking more for a programmatic partner. Again, a lot of them, some of them, yes, don't have the money. That's where, we can talk to them about like co-GPs and bringing in other partners.
Right.
And again, sometimes they do, they max out their network.
No, it happens.
They get this great opportunity that's larger than what they've done in the past, and they just can't access the funds.
I feel like capital calls, when you have that pressure, especially if it's a larger deal than what you
Hmm.
are usually doing, so much pressure. It's so intense to hop on calls and raise a lot more money, like twice, right? Let's say I'm raising typically $5 million, right, for a deal, and now I need to raise 10 or 12.
Yeah.
It's nerve-wracking, especially if I have this deal under LOI, maybe I made some non-refundable deposit. Like the pressure is real. So I feel like when you speak with a sponsor, they say, listen, some of them say, we have the access to deals. Problem is, how can I be confident about me executing the deal? And you never want to handle the time and the time loss, right? That like you're wasting 30 days, 60 days of
Yep.
your time raising capital while you were able to do other deals. So we kind of see two groups. One that is ready for that transition, but they want to meet LPs first, strategize based on something that you have. And the
Hmm.
second one that is the second group, they are not going to make the transition just because that's their comfort zone. This is what they do, and that's fine.
Yeah.
So incredible, Jason, incredible. Thank you for your time. It was a wonderful one. Uh,
Absolutely. Had a good
just
time.
going to say that to the audience. If you are an up and coming sponsor, or if you are an established sponsor as well, feel free to message Jason directly on LinkedIn, Jason Croning, or you can go over our company page or website and you can approach us directly with a deal, with a strategy, with an idea. We can always help, we can always advise. We're not going to connect you to LPs right away. Not going to happen. We need to analyze the situation, strategize. So think about as your strategic partner is going to help you with the alignment, with the due diligence, with everything that you need to do to package this, and then we can execute it through Jason and his abilities. Thank you, guys. Please subscribe to our YouTube channel, follow us on LinkedIn, comment below, and we will see you on the next time. Thank you, Jason.
Pleasure.